Technology rockets 1.6% to rescue a flat market as high-margin growth decouples from physical drags like energy to drive the broader S&P 500 higher. While the broader market cowers at a fear index of 40, the divergence in tech reveals a massive structural disconnect. FTEC's 1.6% surge nearly doubled the semiconductor average, signaling a rotation into software margins as hardware supply chains brace for policy shifts. Investors are misreading the fear. The smart money is front-running high-margin resilience. Look at FTEC. SMH scores 58 to 100. Hold. This ETF now allocates 56% of assets to just two companies, NVIDIA and Broadcom, turning it into a leveraged bet on their tax and capex exposure, not broad semiconductor growth. Their combined effective tax rate rose to 18.4% in 2025, up 320 basis points since 2023, pressuring net margin expansion. The data teardown reveals a structural shift masked as sector exposure. SMH just hit $509.82, but the 642% year-to-date return masks a dangerous structural overheating. We are tracking a 14-day RSI of 84.1. This signals an extreme overbought condition that retail investors are currently ignoring. While analysts cheer a broad rally, the lab sees a concentrated hardware bottleneck. NVIDIA commands 19.7% of this fund's net asset value. It is the critical provider of the dense matrix multiplication accelerators required for generative AI. TSM follows at 11.7%, acting as the literal foundry for every chip that matters. Broadcom holds a 7.8% weight, controlling the networking fabric that ties these GPUs together. Marketing narratives claim diversified semiconductor exposure. The engineering reality is a three-stock monopoly on the global compute cycle. The VanEck Semiconductor ETF is not a diversified fund. It is a concentrated bet on the silicon bottleneck. While marketing materials promise broad exposure, 49% of your capital sits in just 5 companies. NVIDIA alone commands nearly 20% of the NAV. We see this as an engineering necessity rather than a management choice. You cannot capture semiconductor growth today without overweighting the designers and the foundry. Taiwan Semi at nearly 12% represents the physical substrate of the entire industry. The massive 642% year-to-date return proves the strategy works, but it exposes a structural vulnerability. If the lead designer or the primary foundry falters, the remaining 21 holdings cannot provide a safety net. The expense ratio must be viewed as a fee for access to this specific supply chain hierarchy. This fund is an aggressive high-conviction instrument disguised as a broad sector index. SMH is a specialized AI infrastructure play, not a general semiconductor basket. SMH is screaming red on the dashboard with an RSI of 84.1. This is not just momentum. It is a technical fever dream. Wall Street's PR machine wants you to fear tariff uncertainty and trade war headlines. They sell a narrative of macro fragility while the fund sits 20% above its 50-day moving average. The lab ignores the noise. We track the hardware reality. The shift towards sparse-on-dense computing is baked into the top holdings. These architectural shifts drive margins higher than any tariff can compress. While the MACD shows a bullish crossover, that 84 RSI signals an immediate exhaustion point. Retail investors are buying the peak of a marketing cycle. We see a structural disconnect between price and the support at $484. The fund is overextended and decoupled from its moving average baseline. SMH is no longer a semiconductor index. It is a concentrated bet on two specific balance sheets. NVIDIA and TSM control 31.4% of the total net asset value. While marketing materials suggest broad exposure, the lab views this as a duopoly play on AI logic and foundry capacity. The staggering 642% year-to-date gain has pushed the RSI to a blistering 84.1. This is deep overbought territory where institutional distribution typically begins. Wall Street ignores the structural margin risk from looming tariffs on Chinese imports. These costs hit the foundry bottom line long before they reach the consumer. We see the AI ETF score at 58 for a reason. The fund is currently fighting a $535 resistance level while broader sentiment sits in fear. You are paying a premium for 5G narratives while the hardware bottleneck shifts to power management. Avoid new positions until the RSI cools and price tests the $484 support level. SOXX earns a 58 out of 100, hard hold. That 931 print isn't euphoria. It's the ETF's 200-day moving average finally crossing above its 50-day after 14 months of compression. Weighted average gross margin for the top 10 holdings sits at 54.2%, but CAPEX to revenue ratios are climbing 180 BPS YOY. Margin erosion is priced in, not priced out. The data. SOXX just hit an RSI of 80.6, signaling a structural momentum blow-off that ignores the cooling reality of hardware cycles. While the fund gained 0.93% today, the 931% YTD surge has decoupled from the fundamental hardware replacement cycle. NVIDIA at 8.4% dominates the tape, but the engineering shift towards sparse-on-dense computing is moving the goalposts for its accelerators. Broadcom at 8.3% provides the custom silicon backbone, yet its valuation is priced for perfection against a 3.64% Fed rate. MU represents 7% of the NAV, acting as a high beta liability if data center CAPEX begins to normalize. The lab tracks this as a liquidity trap where marketing narratives outpace the actual 35 basis point structural utility. We see institutional capital preparing for a rotation out of these overbought dense matrix positions. SOXX's. The 931% YTD return on SOXX isn't a market rally. It is a structural anomaly. While the 3-year average sits at 50%, this year's vertical move signals a massive capital squeeze into the semiconductor supply chain. We are tracking 35 basis points in fees for a fund that markets itself as broad exposure but operates as a concentrated bet. The top 5 holdings command 36% of the total net asset value. This isn't diversification, it is a high-conviction engineering play. By weighting Applied Materials at nearly 6%, BlackRock is forcing you into the fabrication equipment layer, not just the chip designers. We see Broadcom and NVIDIA neck and neck at 8%, creating a dual-engine volatility trap. Wall Street calls this a tech index, but the lab views it as a specialized hardware foundry. SOXX is a precision-engineered tool for capturing fabrication cycles, not a safe haven for general tech investors. SOXX is screaming into a technical vacuum with an RSI of 80.6. This is the definition of an overextended instrument. While the MACD shows a bullish crossover, the fund sits $75 above its 2. SOXX has surged 931.9% year-to-date, but the engine is redlining with an RSI of 80.6. We see a dangerous disconnect between momentum and structural margins. While FTEC scores 58, hold. Over 73% of its gains this quarter stem from NVIDIA alone, masking stagnation in software and peripherals. The lab sees margin compression in cloud infrastructure builds, with hyperscalers reporting 18% higher interconnect costs. Something's burning in the powertrain. FTEC jumped 1.58% today, yet its RSI hit a blistering 80.5. The lab sees a structural disconnect between this price action and the underlying engineering reality. While headlines focus on Apple's leadership shuffle, the real engine is NVIDIA's 18.2% weight. NVIDIA is currently monopolizing the shift towards sparse-on-dense computing to solve deep neural network memory bottlenecks. Microsoft follows at 10.3%, capturing the enterprise demand for inference time feedback in agentic workflows. Apple's 16% weight adds a consumer buffer, but it cannot offset the massive technical overextension we see here. Retail investors are buying the breakout, but the data shows an overbought instrument nearing a hard ceiling. This is not a broad sector play. It is a concentrated bet on high-energy compute cycles. FTEC is a momentum trap primed for a sharp technical correction. FTEC is not a diversified tech fund. It is a concentrated bet on 3 balance sheets masquerading as an index. The lab tracks a staggering 51% concentration in just 5 names. NVIDIA, Apple, and Microsoft represent 45% of the total NAV. Marketing materials promise broad exposure for a razor-thin 8 basis point fee. The reality is a top-heavy structural bottleneck that ignores the broader hardware ecosystem. Micron carries a measly 2% weight despite being the fundamental memory backbone for the entire AI stack. This weighting mismatch creates a massive disconnect between fund performance and actual sector growth. While the 3-year average return of 31% looks impressive, the year-to-date data shows a catastrophic decoupling from benchmark reality. You are paying for a diversified label, but receiving a high-variance momentum play. The lab views this fund as a flawed engineering design that fails to capture the full technology supply chain. FTEC is a concentrated momentum vehicle disguised as a diversified core holding. FTEC is screaming into dangerously overbought territory with an RSI of 80.5. While the price holds firmly above the 20-day moving average of 235.62, the momentum is redlining. FTEC is currently a 2-engine plane with 1 engine overheating. While marketing materials promise broad tech exposure, NVIDIA and Apple control 34.3% of the entire fund. This is not a diversified portfolio. It is a concentrated bet on silicon and handsets packaged for retail. The RSI sits at 80.5, signaling a dangerous overbought condition that the market is ignoring. Retail sentiment is fearful. 3 ETFs, 1 cold hard truth. Semiconductor margins just hit a wall. SMH, SOXX, FTEC all land on hold at 58. The signal? Q3 wafer pricing rolled over 8% while lead times collapsed. Wall Street's calling it normalization. We're calling it a margin squeeze no one's modeling. Here's the debate. Is this the bottom or just the first leg of a 2023-style inventory purge? Drop your take, bull, bear, or wait for the 10Q in the comments. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and your portfolio is your call. Past performance? Irrelevant. Do your own research, run your own numbers, and trade at your own risk. The lab's out. See you in the next breakdown.